fresh round of tit-for-tat trade actions between the U.S. and China have provided a jolt of volatility to the markets. But what should investors keep in mind as they balance the trade uncertainty with the kickoff of earnings season? Joining us now to discuss is David Fernandez, Managing Director and Co-Head of Global Equity Portfolio Management with TD Asset Management. And Damien, thanks for joining us. There's a lot of volatility, as I mentioned, despite some of the strength we've seen in some of the earnings. U.S.-China trade tensions have flared up again. What do investors need to keep in mind?
I think investors have to keep in two things in their mind, first of all. Thank you, Anthony, for having me on. It's a pleasure. And I just find it actually quite fortuitous that I'm on, and we're always on during these events. And I'm hoping
we planned it that way. But
yeah, I'm hoping we bring some I can at least shed some calmness into this. Let's not forget that trade tensions between the U.S. and China have been continuing throughout this. And I guess what makes it different this time is this was the first time that the U.S. implemented, at least in this spat of trade tariffs that started since Liberation Day. It's the first time China's gone for the non-traditional trade restrictions. Right? Traditional trade restrictions are controls, like for example, export, like how much you can import, or tariffs. Non-traditional is doing what the U.S. was trying to do, which is restricting access to things outside, right? Like software controls, restricting access to key components of the semiconductor chain. China's retaliated now with restrictions on rare earths. And look, we can get into details about what rare earths are. First of all, they're not really rare. That's a misnomer. They're actually found quite plentiful in the U.S. in the crust of most of the Earth's crust. But what is rare, or what makes it special, is China leads in terms of processing and manufacturing these. And these are critical ingredients like magnets that are used in everything from semiconductor chips to defense to electric vehicles to allow the rotors to keep spinning. So there's a whole host of reasons why you need this. And China, for the first time, has while we thought there was an arms stance, they've decided to re-engage, retaliate. And to a certain degree, it's not that the U.S. has been provoking it, but it's not any new provocation. This was them kind of push it to try and probably address some of the grievances they've had, particularly around on September 30th, September 29th, the U.S. put in a rule saying that any country that was 50% or more owned, it was a 50% control rule, would be held to the same standards as the Chinese tariff rate. So China wants to walk back. This is a negotiating ploy. So I think as investors, to the point of your first question, what you should be looking for is November 1st. November 1st is the deadline when both the U.S. retaliatory measures, 100% tariffs, potential restrictions on software, which would be actually quite terminal. Think about if you classify critical software, is Windows critical? Do the Chinese no longer have access to Microsoft products? Or the Chinese completely restricting access. So that all takes place November 1st. What investors should be watching is whether at the margin there is a walk down from these current measures. Like, if this is peak, or if there isn't any, President Xi and President Trump are supposed to be meeting shortly after, if there's no signs of them actually breaking bread together, it'll be very concerning for markets.
All right. Now, we've spoken with you during previous periods of volatility, and your mantra has always been keep calm and compound on. Walk us through your thinking.
Well, I think the market is, especially initially, when this trade disputes first, let's isolate trade from what we were talking about today in your opening comments, which was pretty robust earnings from the banking sector. The U.S. economy earnings have continued to surprise to the upside this whole year. And when I mean keep calm, what I really mean, and what our team tries to employ, is this focus on discipline and evidence. And the evidence right now is telling you that despite the implementation of tariffs, and despite the concerns that many in the media have made about a slowing, the U.S. economy, for all intents and purposes, is it's not great, but it's not bad. It's just fine. Their job growth has come down off its torrid pace, but it's still positive. Inflation is falling. The central bankers are accommodating globally. The Federal Reserve is poised to cut rates. Same for the Bank of Canada. And earnings are growing high single digits. And I think that might be too low again. So in the broad spectrum of risks, where we are right now, if I just gave you those data points and I said, Anthony, how do you feel? And you didn't know anything about the most recent weekend, you'd say things are fine, and markets, are rightly probably so. So I guess when I say keep calm and compound on, what I'm really trying to encourage is people to think, beyond this near-term tit for tat that I think will be. I think there's a high likelihood that both leaders from both countries have to walk them back, because it is pretty significant. And just look at the evidence, and the evidence, at least for right now, is positive. Growth is fine, earnings are growing.
Okay, great perspective. Now, as you mentioned, we also have earnings season kicking off with the big U.S. banks reporting this morning. What's your reaction? What sort of earnings per share growth are you expecting generally?
I think it's more interesting is the surprise. And what I mean by this, right, is when you look at just last quarter was Q2, the end of June. Estimates were looking for, I think, 4% earnings growth, because that's where they thought the activity just was arrested. Because Q2, April, May, June was when peak uncertainty about tariffs. In fact, earnings came in 11%, supported by a lot of AI, but just broadly too. This quarter, people are expecting earnings again to take a step down, earnings to be mid to high single digits. I'll just put some numbers to this, Anthony. Like, year-on-year growth in the U.S. is probably somewhere in the 3% range. That's real. So with inflation, you're probably looking at 5% growth. And when you think that's growth for the economy, the companies in the U.S. and the S&P 500 normally grow faster than the economy. I could easily see the top line revenues growing high single digits, and with any margin expansion, it doesn't take much to stretch that you'll have maybe even potentially low double-digit earnings growth, which, to my initial point, people or estimates continue to be, at least from my perspective, too bearish going in. And we saw this with the banks today, too.
All right. Now, you also say you've been in an AI or bust market. What's been playing out for you?
Yeah, that's a term I've been using recently, and I just think that so much of the market gains, economic activity, advances are just driven by, and I don't call it AI. What I'm talking broadly is just specific AI, but also the data center build out, the increases in infrastructure to support all of this growth in AI. They're all tied to the hip. And I guess this quarter, when the hyperscalers, the Amazons and Metas and Alphabets of the world report, the one number to look for is CapEx spending. Now, we know with the announcements from OpenAI that they're probably pretty good, Broadcom last week, but I think people haven't fully digested the magnitude of how much of U.S. growth and earnings is tied to AI. And if I give you just one number, right, or maybe one number and one percentage. I don't want to talk about ratios and percentage. Right now, data center spend, building out this AI things for 2025 is something close to north of 360 billion. If we assume, 75% of that is domiciled in the U.S., we get to a little over 300 billion. The U.S. economy is 30 trillion. So automatically 1% of growth is just direct hyperscaler spending. And that's before we talk about, the electrician who's in the middle of, Louisiana, who's spending money at the restaurant, or the wealth effects tied to it. It just, all of it. So I guess, longer term for your viewers, what I'm really, really focused on is whether we see, whether all this CapEx investment to support AI, because if there's ever any signs of it start rolling over, that would actually be quite negative for markets, more so than the current trade volatility is being caused.
Now, coming into this earnings season, I think one of the biggest questions is about valuations. Do valuations support? Are they supportive? Given this uncertainty and given just given where we are in terms of the market, the market gains we've seen this year.
Yeah, so a lot of the questions I've been receiving and our team has been receiving, Anthony, has been around, is this .com, right? Mm-hmm. And to be clear, if you're going to compare .com, stocks like the frothy stocks in the .com era were trading at 50 times. where, like the market's at 22, the Nvidias are at like 25, like next year's earnings. So valuations are above average, but they're not terminal in the sense they're at such egregious levels that that warrants a pullback. I think the bigger question around valuation is that people, and this is really important, is that profitability is so much higher today than before, right? If profitability is 30, 40% higher than when it was compared to the average, it justifies a higher valuation. So I guess the better question to be asking is what takes down profitability, free cash flow margins, net income margins. And in my mind, it's the biggest thing is probably like uncertainty tied to just the amount of being spent on CapEx, right? Because CapEx is depreciation expense over time. And if you keep spending it, that can actually, on the negative side, that can potentially pull down margins. But then on the positive side is if you implement AI and if we actually believe what these people are saying, like that could actually pull up margins because of expenses. So that push and pull between how much you're investing to AI and the depreciation expense, coupled with how much you can probably pull up margins, that's going to be where the valuation argument will be fought. But to answer your question, where we are right now, valuations are higher than average, but they're not terminal, they're not obscene. Like I am not, looking to sell stocks at these levels. And if we can hold where margins are, valuations are actually justified.